Welcome to today's Explainer. We're about to embark on a truly fascinating journey today, one that spans almost 2 centuries. It's a story that perfectly contrasts the massive, sometimes pretty clinical scale of high finance with deeply human ethical concepts of community and trust. Today, we are looking at the evolution of Friends Provident. To really understand where we are today, let's kick things off with a number. In 2020, the modern insurance giant Aviva completed a major corporate transaction. They sold their 76% stake in Friends Provident International Limited, or FPIL for short, to a company called RL360. The price tag for that? £259 million. But this massive sale brings up a really compelling mystery, because, as you'll see, Friends Provident didn't start in some glass skyscraper in London. So the main question we're answering today is this. How exactly did a humble 19th century Quaker society transform into a multi-million-pound corporate asset that gets traded between modern financial titans? Let's get into Section 1, a multi-million-pound sale. Now, the structure of this 2020 deal is actually fascinating. Aviva didn't just sell off the whole thing. As you can see, 76% was sold to RL360 for that £259 million, and that was broken down into a mix of cash and deferred cash. Meanwhile, Aviva retained the other 24%. Through all this, FPIL just kept serving its international clients with minimal impact on Aviva's capital surplus. It was a very clean, highly structured corporate maneuver. Section 2. Humble Quaker Origins. Let's hit the brakes on modern finance for a second and rewind all the way back to 1832. Founders Samuel Tuke and Joseph Rowntree started this friendly society with literally zero subscribed capital. None. The entire operation was backed solely by the personal guarantees of prominent Quaker families. And forget about the corporate boardrooms. They literally operated out of a single room right above a confectioner shop in Bradford. Just imagine trying to manage life annuities while smelling fresh pastries all day. They had exactly one employee, a guy named Benjamin Aykroyd, who essentially ran the whole show. So how in the world did they evolve from that single room? Well, growth was steady, but it was also pretty constrained early on. By 1902, their life fund had managed to grow to £3 million, which was huge, but they hit a hard ceiling because their rules strictly limited membership to Quakers. Basically, to survive, they had to adapt. So by 1914, they finally began accepting non-Quakers, and just a year later, an official act freed them from the old Friendly Society restrictions, officially turning them into a mutual life assurance office. That brings us to Section 3, Growing Pains and Expansion. To really fuel that next phase of expansion, they needed fresh leadership. Enter Henry Tapscott in 1916, notably their very first non-Quaker manager. And his strategy? It was aggressive. By 1918, they went on a massive spending spree, buying Century Insurance for over £500,000. To put that into perspective, that was a whopping 15% of their total life fund's assets at the time. They then used Century's existing network to push really aggressively into general insurance all across North America. But as we know, rapid ambition usually comes with serious risk, and it created a tale of 2 vastly different businesses for them. Back home, their UK life business was thriving. It was showing steady growth and successfully expanded into pensions by 1934. But across the Atlantic, absolute devastation. The 1929 Wall Street crash just hammered their North American investments. They suffered a drop in value of over 50%, and that was coupled with some truly terrible underwriting losses. It actually got so bad they had to cancel their planned centennial bonus. After decades of these volatile general insurance losses dragging down their core business, they finally had to make a really tough call. In 1975, they passed the Friends Provident Life Office Act and completely sold off Century to Phoenix Insurance. Essentially, they officially retreated from the chaos of global general insurance and returned to their historical roots as a life-only mutual company. Moving on to Section 4, Demutualization and the Modern Era. What followed next was just a relentless sequence of corporate deal-making. In 1997, a £132 million merger created Friends Ivory and Syme, but the truly pivotal year was 2000, when they demutualized. They shed their mutual status entirely, listing on the FTSE 100. Then came a massive merger with FNC Asset Management in 2004, before they finally accepted a staggering £1.86 billion takeover bid from Resolution Limited in 2009. To really grasp how far they traveled from that tiny room above the pastry shop, just let this number sink in. £125 billion. That is the staggering amount of funds they had under management by 2004, right after that merger with F&C Asset Management. They were, without a doubt, a bona fide global financial powerhouse. Which leads us nicely into Section 5, the ethical investment legacy. Now, you might be thinking the original Quaker spirit got completely swallowed up by all those billion-pound mergers, but it didn't. Friends Provident actually introduced the Stewardship Fund, which was literally the very first fully ethical investment fund offered in the United Kingdom. This was an absolutely crucial innovation. It was a direct, tangible descendant of their roots, proving they were really early pioneers in figuring out how to balance modern profit with deeply held principles. Furthermore, when the company went public in 2000 and shed its mutual structure, they didn't just walk away from their heritage. They made sure the independent Friends Provident Foundation was permanently endowed as a charity. They purposely carved out and fully funded their philanthropic mission to ensure it would actually survive the massive corporate transition. At the very core of that foundation is a pretty powerful mission statement: encourage the right use of money and build a more resilient economy. When you hear that phrasing, you can almost hear the original 1832 vision of Samuel Tuke and Joseph Rowntree echoing right through time. It's the exact same ethos, just adapted for the 21st century. And today, the foundation is incredibly active. After becoming completely operationally independent back in 2013, and now based in York, they focus their grants heavily on things like financial inclusion and empowering civil society. What's genuinely amazing is that starting with just a tiny staff, they became sector leaders in mission-related social investment. They directly engage with huge companies to demand responsible corporate behavior. After a major strategic review in 2012, they launched a specific grant program literally called Building Resilient Economies. The whole goal here is to fund projects that actively combat the instability, the short-termism, and the deep inequalities found in our current economic systems. Think about that. They're actively using the wealth generated by a modern financial giant to fight the flaws of modern finance itself. Which brings us to our final slide, and a question I really want to leave you with today. From a totally uncapitalized society in Bradford back in 1832 to a £259 million corporate asset sale by Aviva in 2020, the thread of ethical responsibility somehow managed to survive through the Friends Provident Foundation. It really begs the question, looking at this history, can modern finance ever truly balance profit with purpose? Or are dedicated ethical foundations the only way to keep the conscience of capitalism alive? Something to think about. Thank you so much for joining me on this explainer.